Hello everyone, and welcome to Market Week in Review for the week ending February 14th, 2025. My name is Bei-Chen Lin. I'm a senior investment strategist and head of Canadian strategy here at Russell Investments. On today's Market Week in Review, there are three major topics we're going to discuss. First, with equity markets hitting all-time highs or hovering close to all-time highs in several regions, what should investors keep in mind? Second, what are the latest tariff developments here in the US and the potential implications that investors need to know? Finally, we're going to do a bit of a preview onto next week's Canadian inflation numbers. Does the inflation data here in the US necessarily translate one-to-one onto the Canadian inflation data? And ultimately, what are the implications for the Bank of Canada? So first, let's talk about the equity markets. This week, we saw the S&P 500 in the US hover close to its all-time high, and we saw the TSX Composite Index in Canada also hover close to its all-time high. In addition, the Stock 600 Index in Europe broke through its all-time high yet again. And so if so many equity market indices hovering near or above their all-time highs, some investors might be wondering, is this time to chase into the equity market rally? Well, from our perspective here at Russell Investments, the answer to that question is no. We do not believe that investors should chase into the equity market rally. Instead, we think that investors would benefit from staying disciplined and staying close to their strategic asset allocation. We think that macroeconomic uncertainty continues to remain elevated. Even though in the US we think that a soft landing is the most likely outcome, we also think that recession risk still remains somewhat above average. In addition, equity valuations in the US are likely somewhat on the stretch side. When we look outside of the US, it's true that equity valuations in Canada and Europe, for instance, are closer to fair value than they are in the US, but there's the offsetting factor that Canada and Europe are more exposed to cyclical risks. And for Canada, if some of these tariffs against Canada are implemented after the 30-day pause, then the Canadian economy could see a very elevated risk of an economic slowdown. And so when you balance these cycle and valuation factors together, we just don't see a compelling enough tactical case at this point in time to overweight equity. Now, we also think that investors don't need to sell out of their equity market exposure or underweight equities from a tactical perspective, but instead, we think that sticking close to the middle, close to their strategic asset allocation, rebalancing their portfolio is probably something that can benefit investors so that they can lock in some of the gains they've made, but also have the opportunity to participate still in any potential future equity market upside from here on in. The second topic, tariffs. So there's obviously been a lot of announcements on this front. This week we saw more announcements. President Donald Trump held a press conference this Thursday where he discussed his plan for reciprocal tariffs on key U.S. trading partners. But what really stood out to me about his announcement was he didn't announce a specific tariff rate, he didn't announce a specific tariff country that he was going to target, and he also didn't announce a specific deadline as to when some of these new tariffs would go into effect. He only instructed his advisors to study the situation and make some recommendations before April 1st. So it doesn't necessarily mean that we're going to see these additional new tariffs by April 1st. We think that this is an important development in terms of how President Trump introduced the plan for reciprocal tariffs, because it gives a lot of latitude, a lot of flexibility to him and his advisors, and ultimately, we think that these tariff talks might be more of a negotiating tool rather than something to be taken literally. Of course, we do need to continue to monitor the situation. As we've discussed in the past, if some of the U.S. tariffs were to be implemented, the U.S. would likely see a modest drag on growth and a modest one-time hit to prices, whereas some of the U.S.'s key trading partners like Canada and Mexico could potentially be more impacted by tariffs. Finally, we're going to talk about inflation. So this week in the U.S., we saw consumer inflation surprise to the upside. Some people might be wondering, does that mean that inflation in Canada is also going to surprise to the upside when it gets released next week? The answer is no. Even though the Canadian and the U.S. economies are so interconnected, they don't always move one-to-one in lockstep with each other. And at the end of the day, we think the Bank of Canada now is going to be a lot more focused on the growth side of the equation rather than the inflation side of the equation. So even if we were to get a slight upside surprise to inflation, the Bank of Canada might look through it as more of a one-time shock, and we ultimately think they're going to still continue cutting interest rates later this year because of the weakness we've seen in the Canadian economy. Thanks for tuning in. Stay tuned for more episodes of Market Week in Review.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.